We got to talk about a coming CPI shock because the initial estimates for January's CPI from economists are out. And remember, the next inflation report isn't until February 14th. Between then and now, we've got a few catalysts to go through. So what I'll do is I'll hit what some of these catalysts are going to be in the coming couple weeks here, coming 10 days. And then I'll talk about what's going on with this CPI shock that we're expecting. So let's hit some catalysts first, and we'll just go in order. So obviously today is Saturday, markets are closed, but we want to prepare for Monday. Monday, we're going to start with Pinterest. Pinterest is going to be really interesting from a consumer point of view because, at least for my purposes, I'm going to be looking at Pinterest for a leading indicator on Etsy sales. I'm an investor in Etsy because I really believe that Etsy's got some real nice margins over a company like Amazon because Etsy is not doing the fulfillment. I think fulfillment is a great way to sandbag your cash flow. You're never going to get it faster. You're better off letting UPS, FedEx, and Amazon fulfillment handle that kind of stuff. Personally, I don't want to be in that business because I think you're in a race to $0 of profit. As soon as you get 2 days of shipping, what happened? Let's go to 1 day. Then it's same day. Then it's going to be drone deliveries. It's the most expensive thing you can get into, in my opinion. Anyway, Pinterest, I think, is going to be a very interesting leading tell for advertisers as well, because a lot of people spend money advertising and companies spend money advertising on Pinterest, including Etsy sellers advertise on Pinterest. So interesting tells on the consumer. We'll get some leading indicators for Etsy. We'll get some sort of more data on Amazon, although we already saw Amazon's earnings. But we'll also learn a little bit for advertisers. What are advertiser appetites like? How does it compare to the advertising declines that we saw at Google? The slight beat, but still reduction in advertising spend that we saw at Facebook, and what could it mean for Trade Desk coming up? Then on Monday, we'll also be talking Activision Blizzard. They just settled with the SEC for $35 million for frat boy culture. I'm not sure if the SEC is taking that entire 35 mil. I imagine part of that is going to the people who submitted these allegations, to the women who submitted these allegations. But obviously looking for insights here on Activision Blizzard to see, hey, are they actually going to get acquired by Microsoft, or is that deal going to get stuck in the mud? Take-Two Interactive reports, Spirit Airlines reports. Now, Spirit, I think, is actually a leading, potentially deflationary indicator we want to pay attention to, because guess what, folks? If the discount airlines start discounting even more, guess what? I think you're going to end up seeing a pricing war from the big boys. American Airlines, United, JetBlue, Delta. These companies are also going to get into a pricing war, and we'll actually see a reduction in ticket prices, which is a disinflationary aspect that we would love to see in the next inflation reports. All throughout this year, I'd love to see airfares actually come down. Keep in mind, the airline industry is still trying to get back to equilibrium. We're still not at 2019 levels of equilibrium. You still have 10% fewer pilots, about 15% fewer overall staff, yet you've got substantially, or you're already basically back to 2019 levels of travel, and those will potentially exceed 2019 levels of travel. So more travel, less capability of servicing, has led to a lot of inflation. Has Let me correct myself there. Has led to prices rising, obviously. And we're hoping that balance starts coming back in the next few months, especially as used car prices are expecting to potentially stabilize and that falling anchor of used car prices goes away. So it'd be nice to see some pickup from airlines potentially competing a little bit more. We'll see Simon Property Group report on Monday. Simon Property Group, one of the largest mall owners in America. They actually own some pretty good quality malls. I personally like the company. I like what they do. I'm not a big fan of investing in commercial real estate, not at this point. I think valuations are quite stretched at this point in commercial real estate. But we'll get some consumer insights here, especially what kind of businesses are going BK, basically, especially not sort of on the big scale like maybe Bed Bath & Beyond, but how many of the smaller stores are picking up and leaving? There was a big belief that we're going to be able to go from a 2019 spending world to a COVID everybody spends on world, and the reopening everybody goes back to the malls. But are people actually consistently going back to the malls? How's traffic looking now compared to the past? Tyson Food, we'll see if some meat prices are coming down. What kind of inflationary aspects are we seeing for food? A really great indicator. Tyson Food should be a great tell for us. I'm a big fan of studying earnings and earnings calls for deflationary signs. So far, almost every single report I'm reading is indicating that the first half of 2023, still tough. Second half expected to be boom time. Now, all of the CEOs could be wrong, but let's just say they weren't wrong in the last time around, where in January of 2022, they're all like, oh, we're going to have some inflationary problems. And sure enough, we did. Tuesday, we'll have Hertz, the rental car company. I think it'll be interesting to see if we have any indicators on their interest in buying even more Teslas. This is something that they're actually big fans of, buying Teslas and Polestars, actually. So we'll see if there's any kind of increase or more motivation now after price drops to potentially take advantage of some lower prices and buying some more electric vehicles. We'll see. Apparently, these rent very well. People want to rent these. And also keep in mind the network effects of renting cars. When car companies rent out cars, one of the neat things that happens is people go in the cars and they're like, oh, I kind of like this car, and they potentially want to buy them. Rental car companies are a fantastic way for companies to advertise their car by actually letting people drive them without actually advertising their cars. It's great. You've got BP reporting Tuesday. You got Fiserv, which is the traditional sort of more legacy fintech, if you will, company that also processes a ton of transactions. I think they represent over 50% of retail store transactions. Think of them as checkout terminals, old cash registers, baby. Obviously, they're trying to change with the times, but we'll get some insight on consumer spending from them. DuPont is an industrial. We'll see what's going on with industrials. So far from 3M and Dow, we've gotten a lot of indicators of layoffs. Industrial layoffs are often the last leg to fall in a recession. So we'll see. Does this mean we're just getting started, or does this mean we're over the pain? Who knows? If you look at the bond market, the pain hasn't even really started yet because of the inverted yield curve and the depth of the inversion. The pain is usually during the re-steepening phase, and we've barely started that. KKR Real Estate, these real estate companies, again, I think they're terribly overvalued, but I'm curious to see what kind of redemptions or how the company's planning on handling the massive redemption requests they're getting. So far, companies like Blackstone and KKR are not fulfilling all of their redemption requests. That's basically when investors are like, dude, we want to get our money out. We want to go buy other stuff. And the company's like, yeah, sorry, the market's trash and we don't want to. But if the company gets forced to, then they might have to liquidate real estate, which could lead to a large bump in real estate inventory. Keeping in mind that after that jobs report, we got a nice little tick up again in that 10-year treasury yield. When you get that tick up in the 10-year treasury, you end up pushing mortgage rates up with it. So something to pay attention to is mortgage rates rising, more liquidations at REITs, a little bit of a risk. Enphase reports on Tuesday. I do think that Enphase is one of the most phenomenal companies that you should consider as an investment. Obviously, hashtag not personalized financial advice for you, but I think it's a phenomenal company. However, there are massive risks. I think all Enphase has to do is say, hey, we're starting to see a drop-off in residential customers being interested in ordering solar panels because they're worried about the housing market going down. Yeah, that could sandbag that stock. You really need growth at Enphase. Now, the stock has thankfully sold off from the insane valuations of the 330s into the low 20s. I actually picked up a few more shares in the low 200s. But there's still a big risk here. Now, for me, I look at this and go, hey, look, if Enphase falls, yeah, if we can get to that 160 level, I kind of want to start backing up the truck potentially. So we'll see. Enphase, I think, is a phenomenal company. Chipotle reports on Tuesday. Now, I am really excited about Chipotle. Now, Chipotle is one of those that they've managed to figure out pricing power with rice and beans, and it's phenomenal. Now, what's also really incredible about Chipotle, though, is they're one of the leading companies coming out right now saying, look, we're hiring 15,000 people for burrito season. I didn't even know burrito season was a thing. I live in California. And it's like every day is burrito season here. I think I have burritos like 3 times a week. Okay, it's just what we do out here. Burritos are freaking awesome. Anyway, and I also, by the way, just learned, like, fun fact, I never knew this, cilantro is actually not an American word. It's a Spanish word for coriander. And I'm like, never knew that. The only reason I learned that is because my dad was saying he was going to cook something and he was going to put coriander on it, which is the same word in German, coriander. And I'm like, what is that? So I translate it, and it translates to coriander in English too. And I'm like, it's just spelled with a C instead of a K. And I'm like, I don't know what that is. So I Google it. It says, in other words, cilantro, the Spanish word for it. I'm like, oh, never knew. Anyway, so apparently they're hiring about 15,000 people for burrito season. If you actually go to their website, you'll see right now, Chipotle has like 3,200 job openings on their website, just like insane how much they're hiring. But the leading indicator is probably the best from Chipotle, in that Chipotle is bluntly saying, look, it's becoming easier for us to hire people. In other words, PP from people are getting smaller. Wage earners' pricing power is going down. Their PP is going down. And that is leading to more capabilities of businesses who want to expand in a recession to actually hire. Now, I actually think that's phenomenal. I'm a big fan and massive believer that in a recession, you double down on your business if you're a business owner, right? And you prepare to take market share. So that way, when you're in that next bull run, you're a force to be reckoned with. That's my thesis. And so I'm a big fan of doubling down. I think that's exactly what Chipotle is doing here. And I respect that. I think that's awesome. So we'll see what happens with Chipotle. That is Tuesday. We've got consumer credit also coming out on Tuesday. Tuesday's consumer credit numbers, we are looking at 25 trillion versus a prior release of 27.96. That would be good because consumer credit has been skyrocketing and it's time for that to come down a little bit. Trade balance is expected to come in at about negative 68.5. Keep in mind that every time consumer credit skyrockets, people start panicking over the idea that consumers are going into massive loans just to sort of sustain their earnings and or sort of, I should say, their spending. In March of 2022, we hit $46 billion of consumer credit, which was insane. It was one of the largest numbers ever. In June, we hit 39.7. It's recently come down to a low of 23, so if we can sort of resettle back to maybe a longer term average, that would be good. Pre-pandemic, consumer credit had a high of about 27, which is roughly the survey we expect now, and it averaged closer to about 22 on sort of a monthly basis. And during the pandemic, there were times, obviously, consumer credit even went negative. People were just paying off their debt. They're like, oh my God, everything's going to end, the world's going to end. Yeah, that was a crazy time. Anyway, Wednesday, we have a wholesale trade coming out, as well as some other earnings, of course. We'll review those. Wholesale trade is expected to be negative 0.2%, and wholesale inventories on the month-over-month basis expected to be 0.1. We have Uber coming out. I don't have too much to say about Uber. I think Uber and Lyft are services that I don't think could ever really make a profit. I think the drivers are the ones who are going to monetize most of the profit, and anything that's really left ends up getting spent on OpEx at these companies. That's not necessarily to say they're bad companies. I mean, after all, they provide food for all of their employees, basically, right? They provide pay for all their employees. So, having a company that makes no money is not necessarily a bad thing because all the people working there make money. I just don't think it's a good investment because that means the investors aren't making money. Then you've got CVS and Disney. Disney coming out on Wednesday. Now, Disney is going to be interesting because Disney is going through this phase of cannibalizing all of the hardworking people's efforts at the parks and the cruise lines, and really the sector that makes money for Disney. Disney makes a crap load of money at their parks. People are spending more money than ever, 50% more per person spending, per capita spending at Disney parks right now. It's insane. People are going nutty, okay? Like, people love spending money at Disney. But the brand value is huge, even though they write their goodwill as even lower than Teletalks, which is like hilarious to me. Disney is a quality brand, okay? We know that. Unless, of course, we want to start talking politics, and then we could have debates about don't say gay, and then everybody's going to start getting fussy and go, what do you mean? What, are you some liberal who loves Disney? Like, we're not going to get into that, okay? We're talking about pee-pee here, okay? We're not going to talk about children politics. We're going to talk about pee-pee, pricing power. And their brand has a lot of pricing power. Now, the question is, and sure, some of that politically has been reduced a little bit, but the question is really, how much money is Disney going to keep throwing into the entertainment world of Disney Plus? Because that's the big money sink right now. It's kind of like a metaverse situation where on one hand, you've got Facebook taking in all this money from advertising, but what are they doing? They're dumping it all into the metaverse. And that's a little bit disappointing for investors because you've got a profitable segment that's feeding a not so profitable business. Now, the hope, obviously, with Disney Plus is that Disney Plus can continue to grow subscriber base, but also grow faster and better than Netflix. Obviously, Disney Plus came out a whole lot later than Netflix. But as of late, they've still been growing better than Netflix. And the goal, obviously, keep that going. But also, I think the biggest, most interesting part for Disney for me is how is the advertising going? Because so far, Netflix suggests the advertising isn't actually going that great, that they're having a rougher sign-up period, and that they're potentially even considering going to a freemium model where basically they give free Netflix service, but then you get a bunch of ads because they're just not getting a lot of people signing up for the pay and still have ad service. It's actually not a terrible surprise to me. But Disney's trying something like this as well, and I'm very curious to see what kind of indicators we can get from Disney for my favorite, Trade Desk and connected TV advertising. So far, it's not looking that great for advertising, though I've got my fingers crossed that Trade Desk can still grow in this recessionary environment. Might take an L on that one, though, so we want to be careful on that. Robinhood Wednesday. Now, I'm very curious also to see how they're potentially making money, because even though we know companies like SoFi are making more money by attracting depositors, offering a higher yield for savings accounts, attracting depositors, and then lending those deposits out and making money on loans, Robinhood doesn't do lending other than margin lending, and margin lending is falling. But they're also now offering 4.15% on cash deposits, which, by the way, is really good. Like, if you've got cash sitting around, in my opinion, you stick it into like a Wealthfront or Robinhood, I don't care what you use, and milk that yield. It's incredible. Like, why bother dealing with treasuries when you could just milk that? It's great. It gives you that liquidity too, instant liquidity. It's phenomenal. So what we've got to consider with Robinhood is they're paying out a lot of their yield, basically, what they could be earning in the market on cash deposits that they have. And so I'm curious to see, as that spread's compressing, is their revenue going down? We'll see. Now, we have had a couple green months here in the stock market, or maybe at least a green January. We'll see if that was, maybe we'll get maybe a good, better set of guidance for the first quarter of the year from Robinhood, but no guarantees. Then we'll also get Affirm. Really big consumer spending play here. But I think biggest part for Affirm is how are those default rates? I don't think Affirm's really been around long enough to actually be popular during a recession. And now we're in a recessionary environment, and Affirm's basically playing the first rodeo of recession. Now, Affirm likes to argue that, oh, well, people need us more in a recession. Sure, but are they burning you more in a recession? We'll see. Goodyear reports, Wynn reports on Wednesday, Mattel reports. If you look at sort of the earnings that we've already gotten from companies like Hasbro, games, like toys, not looking good. So big red flag there for Mattel. We'll see how much of that is already priced in. Consumer and inflationary spend, obviously, for Goodyear will be interesting. And then also Wynn. How's travel doing? How's Macau doing? How is the reopening going in China from the Macau's point of view? And to me, that's actually going to be a Starbucks tell, because I'm pretty excited about what I'm seeing at Starbucks. So then on Thursday, we get Pepsi. We'll see what kind of inflationary costs we're getting at Pepsi. We've got Toyota, Credit Suisse, PayPal, Lyft, Cloudflare. Now that'll be a big one for software as service spend. If Bill.com is any tell, Cloudflare is going to get reamed. Software service companies, especially ones that are not profitable, are probably not going to do too well in the next few earnings seasons. So there's a big red flag for Cloudflare. However, if it can beat on forecasts, it could move bigly. We'll see. I would expect the implied volatility for Cloudflare is probably in excess of 15% for a move in earnings, kind of especially following the Bill.com. And we can actually find out what that is by looking at what the implied volatility is on earnings day next week. And it is, I was close, 12.1% is the implied volatility. The average volatility for the stock is generally for earnings is 5.9%. So you've got 2.5 times as much volatility expected for these SaaS companies. On Friday, we get the University of Michigan inflation expectations read. And then the week after that, we get CPI, which we've just got some of our initial surveys in for. Let me first hit U of M sentiment, and then we'll also look at these CPI forecasts. After this stream, by the way, we're going to start working on changing the pricing as we promised and removing that coupon for the programs on Building Your Wealth link down below. I just wanted to give you a heads up in case you're wondering, like, hey, it's still there. It's like, yep, just woke up. Don't worry, we're going to change that. So we'll get those changes done today. All right, so what do we got here? U of M, sentiment and current conditions and expectations. The survey says 65 for sentiment, 68 for current conditions, expectations 63. These are all slightly higher than the last, with the exception of current conditions slightly lower. But what's interesting to me is the survey actually shows the one-year inflation expectation moving up slightly from 3.9 to 4. Ideally, we come in low on that. The most important thing right now is that we keep inflation expectations low and anchored. That's the most important thing as we go forward, especially after a hot jobs report for January, which we could try to explain away, but let's just be real. It's all going to come down to inflation and inflation expectations. Right now as well, it's worth noting that inflation expectations are via the 5-year break even are still sitting at about 2.3. We could look at this graphically as well. Here on screen now, if you're watching, we can see we're sitting at 2.3. That downtrend is really strong, very, very strong downtrend no matter how you slice it. However, we are still substantially higher than where we were in 2018, especially the Fed went dovish right around here at this bar, which sits you at about 1.6 for the 5-year break even. We're sitting at 2.3 right now, so we've still got some work to do. However, this really reiterates the Nike swoosh scenario of a stock market recovery. If we slowly start seeing it coming down here, we shall see. Next, inflation report as well with expectations. This is sort of the expectation set we've been waiting for. So far, we do not have all of the expectations. For example, we do not yet have a survey in on year-over-year inflation expectations, but we do have some month-over-month numbers. And I think this is actually very interesting. CPI, month-over-month survey. Last month, the actual result was a negative 0.1. This month, for January, it's expected to be 0.5. That's a really high survey. I'm actually really bullish on that. Listen, if this survey comes in really high, guess what? It's really easy for it to miss to the low side, because if it comes in at 0.4, you still win. You see what I mean? Now, 0.5 though on the month over month, pretty up there. And this is not the core measure, this is the headline measure. And it has to do with energy prices having risen. Now 0.5, again, it's hot. That's a 6% annualized rate of inflation. That's not great. We don't want to see 6% annualized inflation. We want to see less, something around 2%. So we'll really have to pay attention to the core survey. Now the core survey is not out yet, but it really sets us up for a shocker. Now, we do have a core month-to-month survey, though. We do have a core month-to-month survey. We just don't have core year-over-year. Okay, so the core month-to-month survey, taking out food and energy, is actually also expected to come in hotter. Last month, we were sitting at 0.3%, which is 3.6% annualized. This month, the forecast is 0.4%. So both of these month-over-month reads are setting up for a high report. Again, though, if we go in with high expectations, it's easier to miss to the downside, which is nice. We want that. Now, not considering core for a moment, If we just consider the headline, we could look at what's been going on with oil. And what we'll find in the last 3 months is we had a spike in January, which this helps explain some of that headline inflation. Look at this. Starting at the first week of January, we actually ran up on Brent, that's your international crude oil cost per barrel. We ran up to about 84 to 87, and we sat there quite a bit under this trade thesis that, here we go. You've got a lot of inflationary pressure because of the Chinese reopening. But what's remarkable about that, because I don't think the Chinese reopening is going to lead to that much inflation, is what do we have over here? You've got this decline in oil prices, international oil prices again, to under 80. So you're actually now starting to get to the same levels that we had the first week of January and some of the lows that we had the first week of December. So I'm excited to see those inflationary pressures on the headline go down and hopefully stay down. But what about core? Because that core month over month, even though we don't have the year over year estimates yet, that core month over month is very interesting to me. 0.4. Why is core expected to rise? Is it because those used cars aren't expected to go down as much? Is it because we're not seeing airfares come down as much yet? Is it because household data isn't coming in weak yet? And so even though that core coming in at 0.4 would be expected to be weaker than where we have been, which has been anywhere between 0.5 to 0.6 in the middle of last year, it's still hot. We'd still like to see this come in at, say, 0.1 or 0.2, so we could really reiterate that disinflationary narrative that's needed in core. Now, be careful though. So far, we only have like 6 to 10 estimates coming in for some of these early estimates. What's going to happen over the next week is we're going to get many more economists providing their estimates. Now, we know they could be crazy off and wrong, but at least it'll give us some kind of guide of what the market wants to beat. And as long as we can beat those estimates, the market usually goes up. So we like that. We like it when the market goes up. Unless, of course, you're a short seller. Anyway, this gives us a breakdown of some of the massive catalysts coming in the next 2 weeks. You'll notice there actually aren't that many other than the inflation report. And really the next FOMC meeting is not until March 22nd. So we've got another 5-6 weeks here before we have to deal with the Fed again. That's also where we're going to get a new summary of economic projections. That summary of economic projections is going to be critical because we want to see a softening from December. But that softening from December, I think, is only going to get written into that summary of economic projections if the CPI report coming up actually comes in weaker than expected. Fingers crossed.